demand. I mean, demand for retail products this year, really beginning with the incredible stimulus package. I think retail investors began to see the writing on the wall. And in addition to stocking up on toilet paper, decided that they would stock up on gold and silver too. And by a real freak of nature, this demand spike coincided with inventory shrinkage, with the fact that we couldn't fabricate retail investment products fast enough and didn't have any inventory. This circumstance is almost certainly temporary. Let me rephrase that. I'm not an epidemiologist. Assuming that the refiners can find a way to bring their workers back to work and keep them safe, my suspicion is that the premiums in the physical market are substantially high enough that those refineries will be working 24 hours a day, 7 days a week, minting a ton of money, and eventually the market will return in balance.
Mm-hmm. Okay. What did you make of I think it was the head of commodities at Bank of America, I might be wrong on that, predicting $3,000 an ounce gold? Because it sounds like you think there's going to be a correction once the supply starts coming back and they try to take advantage of these high premiums.
I don't think there'll be a collapse in the price. I think there'll be a collapse in the premium. I think that the premium associated with retail product will once again more accurately reflect the gold price.
Right.
I think the gold price is higher. Now, Warren Buffett famously said, of course, that predictions tell you a lot about the predictor and not very much at all about the future. Yeah. So perhaps I'm predisposed to believe that. In my experience, the primary determinant of the gold price is real interest rates and the expectation of the maintenance of purchasing power in various savings products. We aren't maintaining any facade as to real interest rates. And anybody who has faith in the ongoing purchasing power of savings instruments in sovereign currencies or sovereign bonds, I would suggest to you is somebody who isn't very good at arithmetic. And so my suspicion is that the pundit, and you named the institution correctly, the Bank of America, was looking at three factors, which I'll recite for you, in terms of being concerned about the purchasing power of conventional savings instruments. The first is quantitative easing. Meyer, if you and I did that, they'd call it counterfeiting and we'd go to jail. Quantitative easing is simply the debasement of the currency, printing up 5 trillion or 6 trillion or some number of currency units unbacked by economic activity or anything else. This is specie conjured up out of thin air. And while you can get away with it for a while, Zimbabwe has proven how well it works over time, and it ain't pretty. The second concern has to be for savers who save in government bonds, as an example, the aggregate levels of government debt. In the United States, there's in excess of $120 trillion in recourse liabilities on the federal government balance sheet, 23 trillion of which are to bondholders, which is to say the so-called government debt. But there's also the whole range of the net present value of entitlements, which the Congressional Budget Office suggests totals over $100 trillion. So anybody who is concerned about the government's ability to pay needs to look at the aggregate debt, which exceeds $120 trillion. That's serviced by the national income, which is taxes and fees minus expenditures. The problem is that that number, the number that we propose to use to pay off the debt, is in deficit. So how do you add a column of negative numbers and come up with a positive sum, particularly a positive sum necessary to extinguish 120 trillion in liabilities? And the answer, of course, is that you don't. The third conundrum, I think, for people who reject the gold thesis is interest rates. Interest is the reward that savers get for postponing their consumption to a later date, and the return that they get for their risk. The world's benchmark savings instrument is the US 10-year Treasury. It pays 65 basis points in yield, in a currency that the Congressional Budget Office says is declining in purchasing power by 1.6% a year. Jim Grant calls that return-free risk.
Right.
And I think the combination of the debasement of the currency via quantitative easing, the balance sheet versus the income statement of the US federal government, and the whole concept of return-free risk means that the wind is very much in gold sails. Again, in my experience, when gold moves, it tends to move pretty dramatically. I remember in the year 2000, gold started the year at about $250 an ounce. And because it was cheap, I had sort of a positive view towards it. I remember thinking, gold, the next 10 years, gold could go up to 700, 800. That was viewed as an outlandish sort of forecast with gold at 250. And I was wrong. It didn't go to 700 or 800. It went to 1800. So while gold's moves might not be frequent, when they move, they tend to be fairly dramatic. I'm not saying that gold will go to 3,000 because I don't know, but I don't think it's an outlandish prediction.
Right. Right. So mostly because of the quantitative easing in that case, that's going to be the biggest effect on the price.
Well, and negative interest rates. If you believed that the U.S. federal government was solvent, and they were paying you an interest rate that compensated you for A, the risk, and B, the depreciation in the currency. If the U.S. 10-year yielded 7, you wouldn't need to own gold, provided that the debt was in a little better condition. But all those ifs don't occur. We're debasing the currency. Our balance sheet is a wreck compared to our income statement. I mean, a wreck. And we aren't being paid any kind of interest to compensate ourselves for the risk or the time value of money. That's a very, very, very ugly triumvirate if you happen to be a saver. Gold, in my experience, as I say, is traded in other countries a little differently, but really contrary to expectation of the yield on U.S. 10-year treasuries. That's been the most important circumstance. And so one thing that's happened is that the U.S. 10-year treasury has been a very, very, very good long-term investment for 30 years as the interest rate fell. If you owned a 7% bond in a 6% world, you looked pretty good. The interest rate peaked, which is to say the bond price was at its lowest in 1981. The U.S. 10-year treasury paid, I think it was 15.6 then. It's been in a 35-year bear market. Now the 15 is gone. It's just the 0.6 that remains. Now, I would suggest to you that a 35-year-old bull market is very long of tooth, particularly when the value proposition is that you get paid 0.6% in a currency that's deteriorating by 1.6% a year. If the bond market, the U.S. bond market, trades inversely to the gold market, and the bond bull market is, for arithmetic purposes, ending, that suggests that we're early on in a gold bull market.